As a business owner, you built something valuable, something that might provide income for your family, jobs for your employees, and legacy for your community. But here's the question that catches many entrepreneurs off guard. What happened to your corporation when you die? Most assume their shares will pass on smoothly to their spouse or kids, that the business will continue running, that everything will sort itself out. But the truth is, without a clear structured estate plan, your death could trigger a series of problems. A massive tax bill on the deemed disposition of your shares, frozen access to your company's bank account, uncertainty over who controls the business, and serious financial and legal stress for your family or business partners. In other words, even if your business survives, your legacy may not. So in this video, we're going to break down what really happens to a corporation when the owner dies and the key estate planning strategy that can help avoid disruption, protect your family, and preserve the value you've worked so hard to build. Hi, if you're new here, my name is Daniel Young, Portfolio Manager, Senior Wealth Advisor from Zenith Wealth Private Counsel, IA Private Wealth. If you find this helpful, please sure to like the video and subscribe to the channel for more Canadian tax and retirement strategy. So part 1, you don't just leave business, you leave a tax problem when a Canadian business owner passes away. The government treats it as if you sold all your assets at fair market value, including your shares in a private corporation. This is called a deemed disposition, and it means the capital gains on your shares is triggered immediately, even if no money changes hands. Let's look at a simple example. Imagine your corporation is valued at $2 million at the time of your death. You originally started the business from scratch, so your adjusted cost base is zero. The result is a $2 million capital gain for tax purposes. Under current rules, 50% of that gain, $1 million, is included in your income for tax purpose on your final return. Depending on your province of residence and other sources of income, that could result in a tax liability in the range of $450,000 to $550,000. Now here's the problem. The business is still operating. Your family or executor may not have immediate access to corporate funds. The CRA will still expect payment often before your estate can be distributed any assets. Without proper planning, your loved ones could be forced to sell part of the business, liquidate investments, or borrow money just to cover the tax bill. And all of this happens at a time when your family is grieving and your business might be vulnerable. That's why business succession isn't just a legal issue, it's a tax problem, and it needs to be addressed well before the business changes hands. Part 2, corporate assets may be frozen. Here's something most business owners never think about. When you pass away, you're no longer assigning authority for your corporation. That means even though the corporation still exists, access to its bank accounts and assets can be frozen, especially if no one else has been granted authority in advance. That happens more often than you think. Even if your spouse or adult children are named in your will, they can't just walk into the bank and take over. Banks and legal institutions require a probated will or a properly appointed corporate officer or director or someone designated under a continuity agreement or shareholder resolution. Without those in place, corporate operations can stall quickly. So let's walk through a scenario. You pass away suddenly and your spouse is the executor. The corporation needs to make payroll at the end of the week, but the bank account is frozen. Your team can't access funds, vendors' payment, and client work may be delayed. Now imagine this happening while your estate is still being reviewed in probate, which could take months. Even a financially stable business can face operational disruption if no one is authorized in advance to manage corporate affairs. This is why shareholders' resolution, dual wills, and proper corporate records are critical for continuity. This helps ensure that someone, whether it's your spouse, child, co-owner, or trusted advisor, can step in right away and keep things running. And it's not just about the money. If customers or key staff sense instability, they may walk away before the dust settles. The damage to your reputation and enterprise value can be immediate and irreversible. That's why smart estate planning for business owners has to include operational continuity, not just tax efficiency. Part 3, without planning, your family may not be protected. A lot of business owners assume that when they pass away, their spouse or kids will just inherit the business or the company and carry on. But here's the truth. Inheriting a business isn't the same as being ready to run one. And without a clear succession plan, that inheritance can quickly turn into a source of conflict, confusion, or even collapse. Let's break this down. Scenario 1, your family doesn't work in the business. Let's say your spouse or children inherit your shares, but they've never been involved in a daily operation. Suddenly, they're expected to make decisions, manage staff, and deal with clients, often while grieving your loss. They may not understand the business cash flow needs, regulatory obligations, or key vendor relationship. And if there's no clear leadership in place, staff may leave, clients may lose trust, and the value of the business can decline rapidly. Scenario 2, one child is involved, other aren't. This one is extremely common. Let's say one of your children has worked in the business for years while the other have pursued different careers. You want to treat your kids fairly, but if they all inherit equal shares of the company, you risk dispute over direction and decision making, resentment from the child who built the business with you, or pressure to sell the company to split the proceeds evenly without a clear framework, either through a shareholder agreement, dual wills, or family trust. This situation can become a legal and emotional nightmare. Scenario 3, no liquidity in the estate. Another major problem is when most of your net worth is tied up in the company. Your family may face a large tax bill from the deemed disposition of shares, ongoing operating costs, funeral and legal expenses, but no cash to cover it all. In some cases, this forces the estate to sell part of or all of the business, even if it wasn't your intention. It's not about lack of effort, it's about lack of liquidity. All of this point to one thing: you can't separate business from your estate plan. If you want your family to benefit from the business, not to be burdened by it, you need a structure that addresses who will take over, how they'll be compensated, how the rest of the family is treated fairly, and how taxes and liquidity will be handled. That's what we'll cover in the next section, the actual tools and strategies that can bring this to life. Part 4, a proper estate plan changes everything. The risk we've talked about, taxes, frozen assets, family conflict aren't inevitable. With the right planning, business owner can take control of how their company is handled after they're gone. You can reduce taxes, preserve the value of your life work, and make sure your family doesn't face unnecessary stress or financial hardship. Let's walk through 4 powerful tools that can make all the difference. Number 1, dual wills. Keep the corporation out of probate. In provinces like Ontario, you can use dual wills to separate your business assets from your personal ones. Here's why this matters. When your estate goes through probate, estate administration tax is applied to the value of your assets, about 1.5% in Ontario, for example. If your corporation is worth $3 million and it's included in your general will, that's going to cost $45,000 in probate fee, plus the delay in paperwork that comes with it. But with a dual will strategy, your corporation shares are handled under a separate secondary will, which can often be exempted from probate. This saves time, reduces costs, and keeps sensitive business valuation out of the public record. Shareholders agreement set the rules in advance. If you have business partners, a shareholder agreement is non-negotiable. It spells out exactly what happens to your share if you pass away. Can the company buy them back? Does a surviving partner have first rights of refusal? How are the shares valued? Is insurance in place to fund the purchase? Without this agreement, your partner could be stuck negotiating with your estate, or worse, end up co-owning the business with your spouse or children, who may not be equipped in or interested in running it. Shareholder agreements are about clarity and fairness for your family, your partners, and the business itself. Number 3, estate freeze with a family trust. An estate freeze is a powerful tool for passing on your business tax efficiently. Here's how it works. You locked in the current value of your shares, say $2 million, and exchange them for preferred shares that won't grow in value. Then you issue new common shares to a family trust, often for the benefit of your children or future generations. All future growth of the business now accrued outside your estate, meaning lower taxes at death. This also allows you to use a lifetime capital gains exemption strategically, distribute future income and capital gains among multiple beneficiaries, maintain control through preferred voting shares while shifting value over time. It's a flexible and effective way to manage succession, especially for family-owned businesses. Number 4, corporately owned permanent life insurance. This is one of the most tax-efficient estate tools available to business owners in Canada. Here is the idea. Your corporation owns a permanent life insurance policy on you. It pays the premium, usually with after-tax dollars. When you pass away, the death benefit is paid into the corporation tax-free. The portion of that amount is added to the capital dividend account, CDA. The CDA can then be used to pay tax-free capital dividends to your estate or beneficiaries. Subject to proper accounting and declaration, this provides liquidity that can be used to help pay taxes, facilitate shareholder buyout, or equalize the estate if some heirs are involved in the business and others aren't. It can also help distribute corporate funds to your heirs more efficiently. When used alongside an estate-free freeze or shareholder agreement, corporate-owned insurance becomes an anchor in your succession plan. So why this matters? Estate planning for business owners isn't just about who gets what. It's about ensuring your family is protected, your business survives and thrives, and your legacy reflects the decades of efforts you put into these tools. Dual wills, shareholders agreements, estate freezes, and insurance don't just solve problems. They give you options, and that's what real planning is all about. If you're a business owner and want to make sure your company, your family, and your legacy are protected when you're no longer here, click the link in the description to book a time with me or someone on my team. We'll help you review your corporate structure, succession options, and estate strategy so you can feel confident that what you have built will be preserved and passed on the right way.